Hi everyone, welcome to the this webinar on the introduction of VAT in the UAE. My name is Fazil Soifu. I'm a tax director at Abax, and I'm here with my colleague Antish Marwan, who is a colleague in the tax team here. We have the pleasure of hosting this webinar to talk through the introduction of the value-added tax in the UAE and in the GCC, look at some practical considerations, look at various elements of VAT, such as registration, classification, VAT adjustments, VAT refunds, the VAT compliance process generally, and we'll end up with some commercial considerations with respect to the VAT. If you have any questions along the way, by all means, please, I think you have tools to write us your questions. We can take them along the way, or we can take them at the end. We hope you find this webinar helpful, and we will try and touch on as many items that will be of interest and relevance to you as possible in the next hour. So what is VAT? Basically, the VAT, as many of you are probably aware, is a tax on consumption. It's a tax on goods and services. That's why we call it an indirect tax, as opposed to a direct tax on income, personal income or corporate income. And why VAT? Why VAT in the UAE? Why VAT in the GCC? Again, taking you back, sort of by way of background, from the financial crisis at the end of the noughties to the fall in oil prices, there's been a shortfall in revenue in the GCC countries. And one of the ways in which governments have sought to try and bring up revenue again is through the introduction of taxes, and VAT was identified as the relevant one. Hence, this has been on the cards for a while, but finally, from the 1st of January 2018, the UAE and Saudi Arabia have introduced VAT. The rest of the GCC, namely Kuwait, Bahrain, and Oman, have committed to introduce it by the end of 2019 at the latest. The rate of VAT under the law is set at 5%, which is quite low relative to other countries. And what is VAT? As I said from the outset, VAT is a tax imposed on the import and supply of certain goods and services at each stage of production. So the best way to look at it is upon consumption of goods and services at every step of the way, VAT tax is added on is imposed on the value add at each stage in the supply chain, and is collected by a business on behalf of the government. So VAT is ultimately incurred and paid by the end customer, and is collected by a business for the government. In terms of the legislative framework, the main laws governing VAT in the UAE, we've listed here a couple of them. There are other references to the law which governs penalties and other issues affecting VAT, but these are the main ones here. Now, what is VAT imposed on? What do you need to know regarding how VAT will apply to you and your business? When do you need to charge VAT? Do you even need to charge VAT at all? In what circumstances are the goods or services that you provide outside the scope of VAT? All of these are relevant questions, which are sort of the basic fundamental questions that you'd be asking yourself as a business. Over the course of the next few slides, we'll try and tackle these questions, starting with sort of the very basic principles of VAT. Now, VAT is imposed on every taxable supply and every deemed supply made by a taxable person. VAT is also imposed on the import of what the law refers to concerned goods, except as specified in the regulation. There are certain exceptions to that. So in summary, there are two conditions that need to be met in order for VAT to be charged. The first set of conditions, as you can see on the slide here, on the left-hand side, is do I provide taxable supplies or do I provide deemed supplies, or do I import concerned goods? We'll look at each of these in detail in a minute. And then the other question to ask is, am I a taxable person? Now, moving on to the next slide, what is a taxable supply? A taxable supply is a supply of goods or services for a consideration by a person conducting business in the state, and a taxable supply excludes exempt supply. Now, we're making references to various types of supplies here. We will explain these in more detail as we go through the webinar and the presentation. But suffice to say for the time being that the key criteria for the imposition of VAT, the first one is you have to be making taxable supply. So if in your business you do not make any taxable supply, then you do not need to charge VAT. So we're talking here about the supply of goods and services made in the state. The state is defined as the UAE. In terms of business, that's a defined term in the legislation. Business is defined as any activity conducted regularly on an ongoing basis and independently by any person in any location, such as industrial, commercial, agricultural activities, etc. Now, as we saw in the previous slide, if I go back here just to show you, there are two sort of set of conditions as to when we charge VAT. The first on the left-hand side is the provision of a type of supply, being a taxable or deemed supply of concerned goods, and then whether you are a taxable person or not. We've looked at the definition of taxable supply. Let's look at the definition of what is a deemed supply and what is concerned goods. So a deemed supply is defined as anything considered as a supply and treated as a taxable supply according to the instances in the law. So the best way to understand this is, if a supply that is made that would otherwise be considered as a taxable supply, but for certain specific reasons is not taxable supply, according to the law, we have to deem this supply as a taxable supply, and VAT has to be charged on that. For example, a supply that is made for no consideration. Strictly speaking, by the letter of the law, that supply would not be a taxable supply because there is no consideration. However, in certain instances, the law deems that supply to be a so-called deemed supply and brings it within the scope of VAT, so VAT has to be applied on it. Now, what is concerned goods? Concerned goods are goods that have been imported and that would not be exempt if supplied in the state. So if you had bought the goods within the state, within the UAE, tax would have been imposed on those goods. So they are standard rated goods or zero rated goods, as we will see later. Then these goods form part of, as we saw earlier, one of the conditions where you need to charge VAT. So if you provide, to summarize, if you provide taxable supplies, or if you provide deemed supplies, or if you import concerned goods, or a combination of them, you may have to charge VAT if you also meet the condition that you are a taxable person. Now, who is a taxable person? In what conditions or in what circumstances do you become a taxable person? We will look at that in the next few slides and talk about VAT registration. My colleague Antish will talk you through the next few slides regarding registration.
Thank you, Fazil. So, as Fazil was discussing earlier, to look at the imposition of VAT, we have to look at two limbs or two conditions. First, whether there is taxable supplies or deemed supplies or concerned goods, and secondly, whether I am a taxable person. Now, to look at whether you are a taxable person or not, we need to look at the definition that has been provided by the legislation, The law defines a taxable person as any person registered or obligated to register for tax purposes. So if you fulfill this criteria, and if you fulfill the criteria for taxable supplies or deemed supplies or importation of concerned goods, then you will have to impose VAT on your supplies. So to know whether you're a taxable person, we look at whether you need to register for VAT. The legislation provides for two criteria for registering for VAT. Do you fall within the mandatory registration or voluntary registration threshold? For mandatory registration, the law provides for a set of conditions that needs to be fulfilled. First, the person has to have a place of residence in the state or in an implementing state, and the total value of all supplies must exceed the mandatory registration threshold. In this case, the mandatory registration threshold is set in the UAE at 375,000 dirhams. Now, if you do not fulfill this criteria, you can still look at whether you need to register for VAT under the voluntary registration threshold. The voluntary registration threshold looks at the total value of supplies or expenses subject to tax incurred during the previous 12 months and whether they exceed the voluntary registration threshold. This threshold is set by the legislation at 187,500 dirhams. Now, the next question is, what do we need to look at to determine whether we are exceeding this threshold? The law specifies that we have to look at the taxable goods and services of a company or of a person. So by reference, the threshold is determined to the taxable supplies of a person. So we relate back again to the taxable supplies. So if your taxable supply exceeds 375,000 dirhams, you have to mandatorily register for VAT and you become a taxable person. Now you have a choice under the voluntary registration if your taxable supplies exceed 187,500 dirhams. Once we have established that you are a taxable person, then we can look at the VAT imposition. But the law also provides for a tax group registration. For the tax group registration, a tax group or a company within a group has the choice to register one company as a representative member for VAT purposes. There are certain advantages of registering one representative member to account VAT for the group. It does make, on a practical sense, it does make administrative ease to register one member as a tax group. In a tax group also, the legislation provides that intra-group supplies can be disregarded. However, there are certain conditions that are asked by the legislation to be able to register for a tax group. First, each member of a group shall have a place of establishment or fixed establishment in the UAE. The relevant persons shall be related parties. And finally, one or more persons conducting business in a partnership shall control the others. The executive regulation then defines the related party relationship. It defines related parties as persons associated in economic, financial, and regulatory aspects, listing a number of criteria to be taken into consideration. So if you think that you find yourself in a position to register as a group, then you can seek assistance to know whether the related party condition is met so that you can register a representative member as a tax group for VAT purposes. Then the member of a tax group becomes the representative member and the supplies are deemed to be made by that representative member. Once you have established that you have taxable supplies and that you have to register that you meet the mandatory threshold or the voluntary threshold, then you have to go through the registration process for registering as for VAT purposes. The process that has been established by the FTA, the Federal Tax Authority, is an online process by creating an e-services account. You have to click on the register for VAT and complete the form by inserting all the details. Now, you can seek assistance to complete the form, and the FTA has also published a guideline to know to help people to register for VAT. However, you need to be aware that failure to submit a registration application within the time frame specified is subject to a fine of 20,000 dirhams. Although this has not been applied yet, we suggest for firms to go and register as soon as possible and to get this obligation out of the way. Now, once the person or the company has registered for VAT, the next step is to know what is the classification of the company's supply. So the VAT classification will determine what rate to apply on the supply of the person or the company. It can be out of scope of VAT, it can be exempt from VAT, zero rated, or even standard rated. So what do we mean by out of scope? If, for example, a business is not conducting a business in the state, that is, in the UAE, it may be out of the scope of VAT. The legislation provides that taxable supplies have to be provided by a person conducting business in the state. So if in a scenario where a person or a company is not conducting business in the state, it may be deemed to be out of the scope for VAT purposes. Now, the legislation also provides a list of activities that are exempt from VAT. This includes financial services, supply of residential buildings, supply of bare land, and the supply of local passenger transport. The supply of financial services and the other exempt activities have all been defined in the executive regulation. For example, the supply of financial services can include the provision of loans, advances, or credit. For zero-rated supplies, these supplies include the export of goods, export of services, exported telecommunication services, certain means of transport, precious metals, education services, and healthcare services. These have been defined by the legislation as well, and it is worth mentioning that zero-rated supplies form part of taxable supplies. Finally, standard-rated supplies are at 5% for VAT. The standard-rated supplies are on taxable supplies, and as mentioned earlier, can be on import of concerned goods and concerned services as well. The most important points from that classification is from a practical aspect. Businesses that now have to register for VAT must identify their supplies and classify these supplies for VAT purposes. So if you have already registered for VAT, the next step is now to identify your supplies to be able to classify them and to know which rate to apply. Are they zero rated? Are they exempt? Are they standard rated? Or are they out of scope for VAT purposes? Then the company can seek advice for classification, and then it has to update its processes and systems to reflect these changes so that it facilitates their business. Once the VAT classification has been performed, then the business has to look at how to comply with the VAT legislation. We are not looking at VAT compliance simply on a filing of VAT return aspect. We're looking at VAT compliance on how to comply with the law in general, with several aspects of the law. How do we need to comply with the invoices? Invoices have to be amended, have to be changed to comply with the VAT legislation. Now, the legislation comes with certain obligations in respect of keeping of records. There are certain obligations as well for the filing of VAT returns, and all these to avoid any penalties. The first aspect that we want to discuss is on tax invoices. The legislation states that a registrant making taxable supplies shall issue an original tax invoice and deliver it to the recipient of goods and services. The registrant has 14 days to issue a tax invoice, and if the invoice is in a different currency, it has to convert the currency into dirhams according to the exchange rate approved by the central bank at the date of supply. Now, the legislation also provides for a simplified tax invoice where the recipient of goods or services is not a registrant, or where the recipient of goods or services is a registrant, but the consideration for supply does not exceed 10,000 dirhams. In this instance, the registrant is defined by the legislation as a person who has registered for VAT and issued a tax registration number. So there is an obligation under the new VAT law for a person registered for tax to issue a tax invoice. The law also provides for the requirements of the tax invoice. So what does the tax invoice need to include? There are a number of criteria that it has to fulfill, and the simplified invoice has to fulfill only part of them. The word tax invoice has to be clearly displayed on the invoice, as well as the name, address, and the tax registration number of a registrant. The same details have to be provided for the recipient, and a sequential tax invoice number or a unique number has to be provided on the tax invoice. This enables the person as well as the authority to track the invoice for administration purposes. The date of issue or the date of supply has to be provided, and a description of goods or services has to be supplied. Now, the next criteria provided at number 7 or at subsection H of the legislation is very important, and I would like to draw attention of this. It says that for each good or service, the unit price, the quantity or volume supplied, the rate of tax, and the amount payable in dirhams has to be shown on the tax invoice. So even if there are multiple goods or many services that have been supplied by the business, each of them have to show the unit price. If they are in a different currency, the exchange rate and the amount in dirhams have to be shown for each good or service. Then the legislation provides for the amount of discount, the gross amount in dirhams. For a simplified tax invoice, this includes a total tax charged for them. Now, if you need any assistance, of course, please seek assistance to review your tax invoices to make sure that they comply with the law, or if there are any templates available, please feel free to contact us to make sure that your tax invoices are within the framework of the legislation. Once the tax invoices have been updated, the law also provides for certain requirements to keep records. Now, there is a list of documents that the decree law provides that needs to be kept by a business. It includes the records of all supplies and imports of goods and services, all tax invoices, credit notes, tax invoices and alternative documents issued, and all tax credit notes and alternative documents issued as well. But this is only some examples of the documents that needs to be kept by the business. The legislation provides for a longer list of documents that needs to be kept. But it is worth noting that processes and systems have to be in place in order to keep these documents and to store them should the FTA contact the person to get these documents. Now, the period of time stated by the law to keep these documents is 5 years after the end of a tax period in case of a taxable person, 5 years from the end of a calendar year in case of a non-taxable person, and 15 years from the end of a tax period for records relating to real estate. You will notice that there is a requirement for non-taxable persons as well to keep documents for 5 years. Now, the FTA also accepts requested information in English, but it can ask for a translated version in Arabic. It is worth mentioning that the law provides for a penalty of 10,000 dirhams if these documents have not been kept at all or have not been kept for the required amount of time the first time, and it is a penalty of 50,000 dirhams if the offense is repeated. Now, within tax compliance, we have looked at tax invoices, we have looked at the keeping of records. My colleague Fazil will be talking about the VAT compliance process, which is a very important part for filing of VAT returns.
Thank you, Antish. The process to file a VAT return, all these steps that need to be taken between collection of data all the way to filing the return and claiming refunds can be quite complex. So it's very important that each business looks at each of these steps and each of the issues that may arise depending on the nature of the business, and take into consideration these steps so that the compliance with the VAT profiling process can be done in the most accurate way and without any discrepancies or any material mistakes that could lead to fines and penalties at the end of it. So let's look at the slide here. We've broken down step by step the various elements that are involved in the filing process. So you start from the collection of input and output VAT from your tax invoices. You collate the data basically from all your invoices. We calculate any reverse charge, and we'll explain in a minute what is the reverse charge mechanism. Now, in certain instances, you may have adjustments. For example, there's a scheme called the capital asset scheme, under which certain adjustments may be required. Again, we will go through that to try and explain what that means. It may or may not be relevant for your business. Then once that data is available, you do your VAT computation. You identify the amount that needs to be paid to the tax authorities or the amount that you think it may be due to you. And that amount will be specified in your VAT return, which you will file by a set date, by a set deadline. And then if there is a refund that is due to you, you will claim that refund, and you will correspond with the tax authority to try and get that money back. In case they have any questions, they may reach out to you to try and understand sort of how your computation has been made up, and any other questions that any other clarifications that they may seek to obtain from yourself. So taking each of these one sort of step by step, collecting input and output VAT. Input VAT, just to recap, is the tax that you have paid, that the business and the person has paid when purchasing or importing goods or services, when these services, goods or services have been supplied to him, and it's a cost to that person. Output tax is the tax charged by that person on a taxable supply and any other supply that may be considered as a taxable supply. So as we said earlier in the presentation, VAT is a tax on the value added by a business. So just a simple illustrative example here. You have a business, you've purchased some goods, you've added some value to them, and then you're selling them to your customer. Ultimately, VAT is the tax that is imposed on the value created by your business, on the value added by your business. So in order to understand the amounts that need to go in your computation, you need to identify the amount of input VAT very clearly, and you need to identify the amount of output VAT. And we'll see further down in the slides how you actually net them off to come to the figure that will give you either a VAT payment or a VAT refund. Now, once you've identified your input and output VAT, there's another element which is very important, which needs to be considered. It's called the reverse charge. What is the reverse charge or the reverse charge mechanism? Basically, under this mechanism, a taxable person treats the import of certain goods as if the person was making the supply to himself, and therefore the person shall be responsible for any tax obligations and account for any input or output VAT in respect of those supplies. Intuitively, the best way to understand it is, if you are buying a good or a service from within the state, that person from whom you're buying the good or the service, the seller would have charged VAT on that that supply. Now, if the seller is abroad, so you're buying a good or a service from abroad, then the federal tax authority, the government in the UAE, cannot physically go after that person abroad and try to ask them to charge VAT on yourself. So rather than the government trying to do that, which is onerous and which is very difficult in practice, the responsibility or the requirement to impose VAT is placed upon yourself. So you have to treat this supply or this purchase and charge input VAT on it as if you had bought that good from a local supplier. So effectively, the responsibility to charge input VAT or to charge VAT shifts from the seller, which would have been the case if you were buying the good from within the state, to the buyer, because the seller is foreign. So the buyer accounts for input VAT and would account for an equal and opposite output VAT as if it was selling that good or service to itself. So if your business is VAT registered, the input VAT and the output VAT should net off each other, and the effect should be neutral. If the final destination of the goods when entering the state is another implementing state, for example, goods are imported and transiting through the UAE into another state, then the taxable person shall pay the due tax on the import of these concerned goods. Now, there are certain conditions for claiming VAT under the reverse charge mechanism. We've listed them out here. At the time of import, the taxable person should be able to demonstrate that they are registered for tax. If you are not registered for tax, then you cannot claim back VAT under the reverse charge mechanism. So the reverse charge applies in a sort of business-to-business context. So if you are a final customer that's not registered for VAT, then you cannot claim the reverse charge mechanism. The taxable person has sufficient details for the authority to verify the import and the tax that shall be due on the import, and is able to provide the information as may be required or as required by the authorities. The taxable person must provide its own customs registration number. In case the customs departments decide to verify the import. And the taxable person must have cooperated with and complied with any rules imposed by the FTA in relation to the import. So just to recap, reverse charge will apply on the import of goods and services from abroad, and whereas the requirement to impose VAT would usually be on the seller, because the seller is abroad, that obligation passes on to the buyer of the goods and services. The person in the UAE who is receiving goods and services from abroad will have to apply this reverse charge mechanism. Now, we talked about adjustments. In some cases, adjustments may be required to your VAT numbers. One of these scenarios is if you have purchases of buildings or capital assets under the capital asset scheme. This scheme allows a taxable person to adjust input tax paid on capital assets over a period of 5 years or 10 years, depending on the nature of the assets being acquired. Essentially, what this scheme does, it allows a business to basically stagger the cost of input VAT. So if you've bought an asset and you've incurred input VAT, rather than charging all the input VAT in 1 year, which could give rise to a significant liability or significant cash flow issue, you're allowed to stagger it over a number of years, 5 or 10, depending on the asset, and 10 if it's a building. Now, once you've to recap, once you've collected your input and output VAT, once from your invoices, once you have identified any items under the reverse charge mechanism, once you've made any adjustments, you are left with your input and output tax numbers. And in your VAT computation, you compute you disclose and you compute your input tax and output tax. And if your output tax exceeds your input tax, then you have an amount payable to the tax authorities. Alternatively, if your input tax is higher than your output tax, then there's an amount that you can carry forward the excess input tax, or in certain circumstances, you can get a refund from the tax authorities. So the payable tax, the amount that you have to pay, is the total output tax minus any recoverable input tax that you have incurred in the period. The input tax that is recoverable by a person for any period is the total of input tax paid for goods and services, which are used or intended to be used for making taxable supplies, or zero-rated supplies, or supplies of certain specific items, or in specific scenarios, for example, where the recipient is outside the state where the services are performed. If the taxpayer fails to recover the input tax in the first tax period, he may include the recoverable tax in the subsequent tax period. So if in a period you find that your input tax is higher than your output tax, which means that you have a net cost, it's the default position is to have this amount carried forward and offset against tax payable in future periods. Alternatively, in certain situations, you may be able to claim a refund for that tax. Now, in terms of submission of VAT return, this process again has been facilitated and can be undertaken online. And my colleague Antish will talk you through these steps, the steps involved, and any relevant information in that respect.
So to submit the online VAT return, the legislation has provided a few details on when to submit the VAT return. And first of all, what we need to understand is that the tax period for the submission of a VAT return is the specific period of time for which the payable tax shall be calculated and paid. And in our situation, it can be a monthly or quarterly return. So for the deadline that has been set by the law is that the tax return must be received by the FTA no later than the 28th day following the end of the tax period. Now, for example, if we have a quarterly return for the period January to March, then it should be submitted by the 28th of April. However, there has been an extension to the tax period for the first filing for certain firms and businesses where the deadline has been extended to the 28th of June. Now, there are certain companies with a 3-month tax period that may have not been affected by this, but the best thing to do is to check on the amendments to the first tax period by logging into your accounts on the e-services portal, on the FTA's website, and to see when the first tax return is due. Some may have stayed the same, whilst some may have changed to the 20th of June. So we have spoken about the identification and collection of input and output VAT, about the reverse charge mechanism, about the capital asset scheme, computation and submission of the VAT return. But if where the input tax is greater than the output tax and there is an excess that is being carried forward, there are two options available to use this excess. The first option is to carry forward an offset against future payable tax and or administrative penalties, so it can cover both. Or if the excess is still remaining after the time limit to be specified by the executive regulation, the business, the company can claim the excess from the FTA. Now, what is the time limit has to be defined by the executive regulation or the FTA. But if the excess is available and it has not been set off against payable tax or administrative penalties in the future, it can be claimed from the FTA. Now, the legislation also specifies that the FTA has 20 business days to notify the taxpayer whether the refund claim has been accepted or rejected. And once the notification has been made, if it is approved, the payment has to be made within 5 business days. So after the VAT refund, we reach the end of the part where we talk about VAT compliance, specifically about the filing of VAT returns. Another topic that we wanted to discuss is the provision of designated zones in the legislation. So the legislation provides that a designated zone that meets the conditions specified in the executive regulation shall be treated as being outside of the state. It also states that the transfer of goods from one designated zone to another designated zone is not subject to VAT. The executive regulation has a number of conditions that a designated zone has to meet in order to benefit from this provision. So the conditions that it states is that it has to be in a fenced geographic area with some specific security measures, that it has to have internal procedures, and that it complies with procedures of the FTA. Now, the Cabinet has issued a list of designated zones, but these zones still need to meet the conditions of the executive regulation to be able to benefit from this provision. We have inserted a link to the Cabinet decision if you would like to see the designated zone stated by the Cabinet. Now, with these provisions, the legislation still has a few areas, some aspects that are still unclear. So we had a few meetings with the FTA to discuss the implications of the provisions of the law concerning the designated zones, and we had confirmations on the supply of goods from a designated zone company to another designated zone company, and this will be treated outside the scope of VAT unless the goods are consumed within the designated zone. A second point that was confirmed is that the supply of goods from a designated zone to a company based in the UAE will be taxable, so they will form part of taxable supplies. And finally, the supply of services by a company in a designated zone to another company in the designated zone, or to a company based in the UAE, or to companies outside the GCC will be taxable supplies. So in this sense, for the supply of services, we see that the treatment is very different from the supply of goods. Apart from the very specific carve-out in the law for the supply of goods from one designated company to a company in another designated zone, the law does not provide very beneficial provisions for services. However, there are further aspects to be clarified by the FTA concerning these provisions. For example, the provision of goods to companies to other states in the GCC. So for services, whether if they are not consumed in the UAE or if they are not consumed in a GCC state, what are the consequences? So we are treating this on a case-by-case basis to analyze the circumstances and to know whether these are taxable or not and what classification has to be applied for these transactions. The next aspect of our webinar is the commercial implications of VAT, and I will pass you to my colleague Fazil to cover this. Thank you.
Thank you, Antish. I think as we reach the end of the webinar, we've talked through various aspects of compliance, and from the very reason why VAT has been introduced to the basic principles of VAT, to the different steps involved in making sure that your business is compliant with VAT. I wanted to talk a bit about the commercial implications of VAT and some of the features that will impact your business and that you'd like to be conscious of. The first one is the administration of VAT, the accounting for it, and the overall management of it. It's not simply a case of filing returns at the end of the month or the quarter in order to, and that makes you compliant. The process to be compliant with VAT starts by looking at your core operations, looking at your technology, making sure that within your systems you're able to capture different treatments of VAT for different types of goods and services that you supply. So there's a whole range of internal sort of assessment and operational change that may be required in order to make your systems compliant with, or at least fit to capture information that needs to be that is relevant for VAT. So in order for you to have a smooth VAT sort of process, you need to make sure that you have implemented the right changes at the level of your bookkeeping, your technology, your internal systems to capture the right information. That's the first sort of implication of VAT beyond the sort of the annual, so the periodic compliance process. Along with that is the liabilities or the costs that may arise from the introduction of such tax. Now, as we have seen, input VAT or VAT that you pay on on the purchase of goods or services can be a cost to you. You can recover this VAT against any output VAT, but in certain cases you may find that there is either not enough output VAT, or you have situations where you cannot recover input VAT, what we call irrecoverable input VAT. So that could leave you with a net cost of doing business, where you have to absorb, or you have to basically bear the burden of that VAT cost. That could have an impact on your profit margin, that could have an impact on your cash flow, and you may have to look at your overall supplies and overall purchases to make sure that your business is still sustainable in the in given the introduction of such costs that you previously didn't have in your in your business. Now, another area where you will have to pay particular attention to, where you may not have had any to worry about in the past, is in terms of contracts and agreements, as well as pricing. In a way, pricing is linked back to the liabilities that could be created from VAT. These items are linked in a way because the contracts that you agree, or the arrangements that you agree, you may have determined, or you may have defined a specific pricing mechanism. You may have defined or determined a specific price to in a contract or in an agreement. Do you have to review or revisit that price, or do you have to revisit the terms of the contract and agreement now that VAT has been introduced? That's a question that you need to ask yourself. For example, you may have old contracts that didn't have any language concerning VAT, or you may have rolling contracts that, for example, you sign off every 12 months. The previous 12 months, there was no VAT, but the next 12 months, there is VAT that may be charged on the services under the contract. How do you account for that? How do you factor that into your contract? How about contracts like even business leases, which could attract VAT going forward? How do you factor the cost of that into your in your contract? In terms of pricing, let's say you used to sell a service previously at 1,000 dirhams or $1,000. Going forward, your customer would still expect to pay you 1,000 dirhams or $1,000 for that item. But now you turn back to them and you say, hey, I have to charge an additional 5% VAT on that price to you. How would your customer react to that? So first of all, do you need to make it clear to your customer that the 1,000 that you were charging to them is exclusive of VAT? So there's VAT that's going to be added on top of that. Perhaps that might be something to to think about, something to make clear from the outset. If you have customers whereby there's long-standing relationships and you don't want to upset them by charging an additional incremental tax, do you absorb that cost in your pricing? Which means, do you still charge them the same price as before, but you absorb that VAT cost internally and you try to recoup it in a different way? These are all good sort of questions to ask yourself, because each of these answers to each of these questions will have different sort of commercial implications for you. The overall, what we can say is that VAT is often seen as a compliance burden, but it goes a lot more beyond that. There's many other things that you as a business you need to think about. As we have seen, everything from pricing, from customer relationship, from your profitability of your business, from managing your cash flow, and from having systems and processes that are ready to be able to get the right VAT numbers at the end of each period. These are all extremely important factors that you need to take into account in order to have a successful implementation of VAT. And we can learn lessons from one of the countries that most recent countries to implement VAT was Malaysia a couple years ago in 2015 actually. And some of the lessons that we learned from that experience, again, the things that we've talked about in this webinar, an early management of systems, identification of changes that may be required, identifying the adverse impacts of VAT on your business, turn these adverse implications onto potential opportunities or changes that may be required, and manage the risk of future changes or manage the risk of the introduction of VAT on your pricing, your client base, your client relationship, and your ongoing sort of normal business activities. How could your business change as a result of the introduction of VAT beyond the mere imposition of an additional 5% tax on the cost of your products? So this is sort of, I think we've reached the end of the webinar. I mean, we hope that we've covered the main areas that would be of relevance and importance to you. Certainly, there's a lot more that can be said on VAT. There's a huge amount that can be said, but we've tried to touch on the key aspects of this new legislation. Hopefully, it has been helpful to you. And if you have any questions, I think you have the tools to be able to send us your questions on screen. But alternatively, we've listed our details here. Please feel free to contact us if you have any queries. We hope you found this webinar useful, and we look forward to hearing further from you at a later date in the future. Thank you.